In this video, we'll go over the 6 finest monthly dividend ETFs for you to invest in. That's right, ETFs with monthly dividends. This list of exchange-traded funds, or ETFs, don't pay dividends every quarter, but instead every month. You'll get the greatest bang for your buck if you do it right with these ETFs. So let's get started and stop wasting time. But before I list down these ETFs, don't forget to hit that like and subscribe button to get more content like this. Alright, let's move forward. At number 6, we have DHS, or the WisdomTree US High Dividend Fund. This is a mutual fund that invests in the US stock market and pays out high dividends. This ETF is designed to track the performance of a stock, particularly ones with a high dividend yield, which are listed on the US stock exchange. In simpler terms, you don't have to spend your time investigating and attempting to locate the highest dividend because this ETF already does that for you. This ETF currently holds 315 stocks. Some of the company's main holdings include companies you're probably familiar with, like Pfizer, Cisco, Verizon, Coca-Cola, and AT&T. Because this ETF owns a number of strong companies, it has a strong track record of performance. DHS has given an average yearly return of roughly 11.57% during the last 10 years. This means that if you had invested $10 in this ETF 10 years ago, your investment would have grown to about $30,000, and that's on top of the ETF's strong dividend yield of 3.7%. We'll go through several additional ETFs that offer even better dividends than this one, which isn't even the highest on our list. Let's talk about DHS's risk level and cost ratio. On a scale of 1 to 5, with 1 being the least hazardous and 5 being the most risky, I'm going to give this ETF a 3. And in terms of the expense ratio, it's not the cheapest ETF in the world, but it's also not the most expensive. On a $10,000 investment, you can expect to pay $38 per year if the expense ratio is 0.3%. In general, I would consider anything with an expenditure ratio of less than 5% to be a cheaper ETF, whereas anything with an expense ratio of more than 5% to be more expensive, and DHS is under 5%. At number 5 is SPHD, also known as the Invesco SP500 High Dividend Low Volatility ETF. The SP500 Low Volatility High Dividend Index, which measures the performance of the SP500's 50 least volatile high dividend yielding stocks, is the basis for SPHD. This index was created as a benchmark for investors aiming to generate income from their assets, and because SPHD was built around it, it's safe to say that it's a great addition to your dividend portfolio. SPHD presently owns 51 stocks, including Iron Mountain, ExxonMobil, and a few other less well-known businesses among its top holdings. We can't look at the ETF's 10-year performance because it was launched in 2012, so we can't compare it to other ETFs. However, you can see that this ETF has had an annual return of roughly 11.03% since its debut, which indicates that $10,000 invested in 2012 would be worth a little over $23,000 now. This ETF will also give out a monthly dividend of 3.86%. This ETF is a 3 on the risk scale, which I believe is a reasonable assessment given that it only invests in low volatility stocks. If you're an income investor, the expense ratio is 0.30%, which means you'll spend $30 per year on $10,000 invested. SPHD is unquestionably a great alternative for you, but so are the other 4 on this list. PGX, or the Invesco Preferred ETF, is ranked 4th. PGX aims to mirror the performance of the ICE BOF AML Core Plus Fixed Rate Preferred Securities Index. I'm always curious to know who comes up with these index names and if there's any way they could come up with something a little more easy to remember. In any case, this ETF is a market cap weighted index that tracks the total return performance of fixed rate US dollar denominated preferred instruments. That may sound confusing, but it simply means that PGX only invests in preferred stocks. Preferred shares are a type of stock that pay a fixed dividend on a regular basis, comparable to a bond. However, preferred stocks differ from bonds in that you retain ownership of or partial ownership of the company when you own shares of preferred stocks, but bonds don't give you that. When opposed to common shares of stock, which are what 99% of retail investors participate in, preferred shares of a company are also recognized for giving out greater dividend yields. Over the last 10 years, PGX has held 301 preferred share issuance, with top holdings in Citigroup, JP Morgan, Chase, Wells Fargo, and many more. PGX has returned roughly 6.73% each year, which indicates that $10,000 put in this ETF 10 years ago would be close to $19,000 today, with a dividend yield of about 4.87%. Because this ETF invests only in preferred shares of a company, it has a higher cost ratio of 0.25%, which means you'll spend $52 per year on a $10,000 investment. Because this ETF invests only in preferred shares of a stock, it has a somewhat lower risk rating of 3 on the risk scale. DIV, or the Global X SuperDividend US ETF, is ranked third on our list, quite similar to the fifth ETF on this list. The only difference between this one and number 5 is that DIV invests in low volatility, high dividend paying stocks across the whole US stock market rather than just the SP 500. CubeSmart, Public Storage, Pfizer, and others are among the top holdings of DIV, which owns 50 of the best dividend-yielding equities in the United States. Because this ETF was formed in 2013, it's still very new, and we're unable to track its 10-year performance. However, since its launch in 2013, it has averaged a 4.67% yearly return. While this ETF's growth is a little slower than the others on this list, what it lacks in performance, it makes up for in dividend yield. DIV has a dividend yield of 5.80%, which is the highest on the list so far. But it also has a high expense ratio of 0.45%, which means you'll pay $45 per year on a $10,000 investment. On the risk scale, I'm going to give DIV a 5. I believe that the fact that this ETF only invests in 50 firms, as well as the poor returns and higher expense ratio, makes it a riskier alternative, especially for new investors. SDIV, or the Solactive Global X SuperDividend ETF, is ranked number 2 on our list. And you might remember it because the previous ETF was DIV, and this one is SDIV. This is a very similar ETF, but with a small twist from the same business. Instead of investing in 50 of the greatest dividend-yielding firms in the United States, this ETF invests in 100 of the highest dividend-yielding stocks around the world. This ETF now has 104 stocks in its portfolio, including China Power International, Yanzhou Coal Mining, and a few more names you're unlikely to recognize among the top holdings. This ETF has only returned roughly 3.10% each year on average over the last 10 years, implying that $10,000 invested 10 years ago would only be worth about $13,600 today. So while your hypothetical $10,000 investment isn't losing value, it isn't rising as much as it would have if you invested in a growth ETF or even a VOO. However, as I previously stated, you normally gain in dividends what you lose in capital appreciation. The more dividends you earn, the less capital appreciation the ETF or stock will enjoy, but that should be good if you're investing for income and as long as the ETF or stock does not depreciate. SDIV now pays a monthly dividend and has a dividend yield of 6.83%, similar to the other ETFs on this list. In terms of risk, we'll assign this a 5 on the risk scale because it invests substantially in international markets, which are actually more volatile than US stocks. This ETF has an expense ratio of 0.59%, which is on the higher end of the spectrum. It means that on a $10,000 investment, you'll pay $59 every year. Finally, the number 1 monthly dividend ETF on this list is KBWD, or the Invesco KBW High Dividend Yield Financial ETF, which is based on the KBW Nasdaq Financial Sector Dividend Yield Index, which is a dividend yield weighted index of US financial companies with high dividend yields that are typically engaged in the business of providing some type of financial product or service. This includes those in the sectors of banking, insurance, loans, and other similar services. This ETF only includes roughly 41 stocks, including some names you're unlikely to identify as top holdings. These are all financial institutions that offer financial services and goods. Despite the fact that it will never be able to rival Cathie Wood's ARK Invest in terms of performance, this ETF has been a relatively strong performer, especially for something with such a high dividend yield. The current 10-year average is roughly 8.75% per year, so that $10,000 invested 10 years ago would now be worth around $19,000. The exceptionally high dividend yield of this ETF, which now stands at 7.37% according to Invesco's yield performance statistics, is where it really shines and why it's ranked first on the list. However, that high yield comes at a cost, and that cost comes in the shape of a 1.24 expense ratio, which is more than double the cost of the most costly ETF on this list, SDIV, which had an expense ratio of 0.59%. This ETF therefore has a risk rating of 5 since it only invests in 41 firms, all of which are financial companies whose performance will fluctuate depending on the interest rate environment in the US. While this ETF has the greatest dividend yield of all the ETFs on our list, it also has the highest expense ratio and other risk variables to consider when picking which ETF to add to your investment portfolio. And that concludes our list of 6 monthly dividend ETFs that will provide you with a steady stream of income. Really hope you found this video useful, and if you did, please leave us a like and subscribe as they would highly be appreciated. See you in the next one.